Hey guys, super happy to be here once again. And today, this is the first time that we're having part B for the Trade Pod. And today we have the one and only Gordon Scott. So, Gordon, it's an absolute pleasure to have you here once again. I'm super happy. How are you?
I'm doing well. Thanks for having me back.
Thanks for being here back. So, I'll just let you know that the episode that we have recorded recently, uh, I think catched like the most of the traffic that the podcast viewers went on, which is incredible, meaning that they really liked your value. So we have decided together to make another one, and I think that this one will be even much more exciting. So like they do with TV series. So previously on our show, we discussed that we'll be talking about the art sign law and its importance about trading. So yeah, let's dive deep into it.
Okay. Well, let me preface this discussion by saying that I just wrote a chapter for the CMT curriculum. The CMT Association is the organization which certifies charter holders in the market technicians world, the professional technical analysis people. The like a CFA, that's a designation. CMT is a designation. That's what I have at the end of my name. And they came to me and asked, would you write our new chapter in the 2025 curriculum that talks about the efficient markets hypothesis? And I
Oh
was
my
delighted
God.
to do that. Yeah, I was delighted to do that because there's this very key principle that sort of is just unexplored really in the literature up to this date, up to this point in time. And for anybody who doesn't know, the efficient markets hypothesis is a term coined from a paper written back a long time ago in the 70s by Eugene Fama and Kenneth French, and they came along with this idea that they had a hypothesis that you could classify markets into, I mean, classify the way to test how a market responds. That's really what it amounted to. And their hypothesis was the market isn't efficient all the time. The market efficiently responds to information. So the question is, what kind of information pushes prices around? And does the market quickly and efficiently respond to that new kind of information? And another guy who wrote a paper came along and said, here are three different tests, three different classifications of test: the strong form, weak form, and the strong form, semi-strong form, and weak form. That's what they ended up getting called. And so this whole idea has been around for about 50 years and has led to the generation of a lot of indexing strategies of all different types. It's very, very powerful as an idea. And it's really hard for anybody to come along and say, oh, but that idea is wrong, right? Eugene Fama himself recently said, okay, the idea might be wrong, but tell me something better. Offer something better than the efficient market hypothesis, and then let's talk, because today we don't have anything better. And he makes a great point. We don't have anything clearly better stated that here's a better model for prices, right? So if you have to be stuck with his model, with the efficient market hypothesis, shouldn't that mean that there's no point in any kind of attempt at investing or trading, especially not trading, right? Because the three different tests are, strong. That's like insider information, non-public information, and then the semi-strong is publicly available information about things like uh, a business's fundamental details or a market's underlying factors, maybe the central bank or something that's pushing a market to do a certain thing and move in a certain direction. And the information is publicly available, but it requires a lot of study and a lot of skill to sort of parse it out and understand it. If that information changes, then it precipitates changes in market prices nearly instantaneously. That's what market efficiency should represent. And the whole
Hmm.
investing world has kind of landed right there. Strong, they don't know because, like, well, we don't know what we don't know. We don't know what's non-public. How do we even test that? But semi-strong, it's publicly available information, and there are lots of people that trade on that, that they are really smart, and they come up with these ideas, and they get a little bit of advantage. So that one must be the case that that there's value there. But then there's the weak form, and they say that's all past prices and price data, which would include volume as well. And so people look at that and they're like, there's nothing there. You cannot get anything out of uh, past price data. And we can prove it because what we can prove is that prices are random, right? So you get you get the book A Random Walk Down Wall Street and Fooled by Randomness. Those two books probably have been the most influential over the past several decades for helping people adopt this belief that prices just move in random ways. Okay,
Hmm.
so what I did about 12 years ago was I said, okay, let me just accept that premise and assume that market prices are random. And if that's true, do I have absolutely no hope, no possible way of understanding how, with technical analysis or any kind of price and volume data, to actually come up with an edge in the markets, to either generate alpha as an investor or find a trading edge as a trader? And I spent 2 months trying to answer that question. And the way I approached it was saying, I'm going to prove the efficient markets hypothesis is correct. That is, the weak form is there's no value in past data. It's all just random, and you cannot predict, and therefore there's no value in it. And I tested and tested, and it kept looking like I was going to be successful at proving that possibility, until I came across one particular corner of all my tests, and that was the area where I was testing trailing stop strategies. And I found that all of the trailing stop strategies had a strange anomaly to them, that they had a sort of built-in edge. It wasn't very much of one, but it was more than would account for just market randomness and that there was something there. I thought, why should trailing stops have an edge? Even if it's a small one, why should they have an edge? And so I went looking for any sort of principle or equation or theory or anything that could help me understand why that might be true, if in fact
Hmm.
it was true. And I came across something called the arcsine law. And the arcsine law is a tenet of probability theory. And so, it's not part of most of the lexicon of finance. It's part of mathematics. But the idea was, even if you have a random series of data, there is something that is predictable about it. And that is your random data walks, random sets of time series data, they are more likely to trend in one direction or another. One will say which direction, right? But they're more likely to trend than they are to stay the same. That's the basic idea behind the arcsine law. Now,
So,
if
so
I
the
can share
idea
my
behind the
screen.
Arcsan law is to enable people to look at a data series factor, and basically to enable them to do like to predict the next move.
Um, it wouldn't allow me to predict the next move. So it doesn't undo the weak form tests in the efficient markets hypothesis.
Sure.
It wouldn't allow me to. Now, first off, are you seeing the graph, this
Yeah,
U-shaped graph
yeah,
on
I
your
see,
screen?
I see the
Okay,
graph.
great. Okay, great. Well, I'll come to that in a second. Okay, so the arc sign law won't allow me to predict what's going to happen next, but it will allow me to say that over many trades, I can expect that trending behavior will occur more often than mean reversion. That's what it will.
Hmm.
That's what it tells me in a very big picture sense.
All
And
right.
so with that knowledge, I recognize then that if I want to be a trader, or especially if I want to be an algorithmic trader, I need to have rules and procedures that allow me to capture trends as they occur or as they continue on, um, and just have an efficient way of capturing those trends, because those trends will occur even if the markets are fully random. And if the markets are not fully random, those trends will occur even more frequently than expected, based on what randomness suggests. That was kind of the point. And so I looked at this and I realized there isn't a conflict here. It's not like, does technical analysis not work at all? Is technical analysis just bunk because the markets are random? No. The answer is technical analysis is very useful because the markets are random. If the markets are random, and I like to use the word randomized as a better description. Random just means that, hey, it's a scatter plot. It could be anything. Price of Microsoft was $427 yesterday, but tomorrow it could be $1,035. That's not how the markets work. The markets work, from a starting point, moving a generally predictable distance away, up or down. Is it going to go up or down? How far up or down? That part's hard, if not impossible, to predict. But it happens that way because all the other people in the markets trying to buy or sell, and you don't know when that's going to happen. You don't know when somebody's going to come along and make a huge sale, or 100,000 people are going to come along and make a bunch of little tiny sales all at once. So the randomized nature of order flow is what creates the randomness that we observe in the marketplace. But if we can depend on the idea that markets are going to be random most of the time, then we can turn to the arc sign law and see what it says here. Now, what I've got is this U-shaped graph. If you Google arc sign
Bravo.
distribution, this is one of the graphs that comes up under the images tab. Okay, and what it's showing us is the number of times that heads. This is a coin flip distribution, right? So if you're just coin flipping heads and tails, and the number of times that heads is going to lead out of your number of flips. So in other words, if I flip 100 times, how many times would you expect heads to occur?
If you flip,
If I flip a coin 100 times, how
mhm,
many times should it come up heads?
50 more.
50, right? You should have 50 heads and you should have 50 tails. That's intuitively, because it's a 50-50 response, people assume that, that's intuitive. That's like, well, half the time. I mean, yeah, it might vary 51, 52, 48, 49, but generally out of a whole bunch of 100 flip instances, I should have on average of 50 heads and 50 tails. That is true. However, here's something weird that happens along the way with those 50 heads and 50 tails. Along the way, you're going to get a winning streak or a losing streak, right? It's
Mhm.
highly unlikely that the winning streak will occur right out of the gate, that you'll have, 5, 6, 7 heads in a row right on your first 7 flips. The chances of that happening are like 3% or less, okay? So people look at that and say, well, that can't happen. But if you do the math and find that out of 100 flips, how many times will you get 6 in a row? The probability that you're going to get 6 in a row somewhere out of 100 flips is better than 50%. More like 60 or 70%. I can't remember exactly what it is
It
on
reminds
100.
me, it reminds me of mathematical methodology that called the binomial tree. So it's like,
Binomial, yeah,
it,
yeah.
yeah, so it's like a way to predict the next move or a way to predict what may come next.
Yeah, well,
Um, and
yeah,
it's
it would
really
give you the
effective and
probabilities of what would come next, right?
yeah,
I mean, that's
probability.
what the binomial math will do.
Hmm.
And so this one isn't so much trying to say what's the probability of the very next flip, but it is saying over the course of many flips, what will happen within that period of time. And because these trends occur, these winning streaks or losing streaks occur, what happens is along the course of getting 50 heads or 50 tails, you're going to spend more time in positive territory or negative territory. So the number of times that heads leads out of 1,000 flips here is what this shows, right? This is like somewhere around 2.5% of the time, or a quarter of percent of the time. I'm not quite sure what this scale is. And this one here is it never leads. You know, there are this many cases where it never leads. There are this many cases where it leads all the time. And then along the way, you get this sort of curved shape. And right in the middle here at 500 is the lowest probabilities. So what they're saying is the idea that if you were to draw a line, you know, +1 heads, you go up. I mean, you get heads and you go up 1. You get heads again, you go up 2, right? But that 2 means that you're leading. You're above 0. How much time will it spend above 0 or below 0? But how much time will it spend right at 0 or close to? And the answer is the probabilities are lower, much lower, that you're going to spend time going back and forth across the middle compared to trending away from that middle. That's what this U-shaped graph shows. And you can actually do some spreadsheet math and prove it to yourself. You know, if you were to, let's see, somebody asked me just the other day, how would I prove that in a spreadsheet? And I sat there at dinner and texted them. My wife was so annoyed, like, what are you doing that's taking so long? But I'm like, well, I'm trying to explain the math of this, you know, how you would program this spreadsheet. And she couldn't believe that I would actually bother to take the time. But I was just curious because, it was a challenge to me. Could I actually just in a text explain how to do it? And what I came out with was, if you use the random function, RAND, you know, parentheses, right, in Excel, and you use something like if rand is greater than or equal to 0.5, then 1 for true, -1 for false, right? And then you copy that formula down 1,000 times, then it's going to create a string of 1 +1 or -1, which would represent heads or tails in a coin flip. And then in the second column, you just make a running total of what those are, right? 1, -1, your running total is 0, +1, 1, +1 again, 2. Get the idea, right? And, you know, whatever mechanism you can use in column 2 to do that. And then if you graph column 2, you just bring up a line graph of that column 2, then what you'll see is that line graph will trend away from 0, either to the downside or the upside. If you sit there and just refresh it a couple of dozen times as you look, your eyes will see it for themselves. The trend will move up or it will move down. It will not go across the middle except rarely. Out of 20 times, we're talking maybe 1 or 2 times will it go across the middle and spend equal time back and forth. It'll spend more time going down or more time going up. That's what the arcsign law predicts, and that's how you could prove it with a spreadsheet. Now, how do you turn that into trading?
Which I think,
Profits.
I have listened your entire explanation about the arcsign law. For me, it's fascinating. I really like the thing that we're doing each and every single time here. We're speaking about mathematics and translating it to like examples for the financial markets. Now, for me at least, it pops up that you might have many creative idea like that will enable you to understand what basically might be the next move or to create indicators based on the binomial algorithm. Now, for me, that might be the current idea that I'm thinking about. But what do you think, or how do you think that we can take advantage over the arcane law? And let's further talk about that one.
Okay, what I'm sharing on the screen right now, sorry, market just opened. What I'm sharing on the screen right now is a chart of Google. Can you see that?
Mm-hmm. Perfectly.
Here, I'm going to try to do another form of proof of the arcsign law, which demonstrates the kind of thing you can do to implement the principle of the arcsign law into your trading rules with an attempt to try to capture profits, right? So I started at the beginning of the year 2024, and I started a box which began at the opening price of 2024 on Google. That's GOOGL. So this is the Class A shares. And it can be any stock. You can do this with any stock. I just happen to have Google up here right now. And so what I've done is I've drawn a box that begins at the opening price and closes at the closing price of the month of January. Then I'm going to do the same thing here in February. And their closing price of February. And then now we'll do the same thing here for each of the months. And that's not there. That might take too much time if I spend too much time doing this. But what I'm demonstrating here with these visuals is how you can do this. Now the idea is you're going to draw boxes around a month, 1 month at a time, and then you're going to go a whole year. Now in just the first 3 boxes, I have Google up 1.43%. In the second one, it's down 1.89%. And the third one, it's up 9% for a month. Now, if I were to go through and do this for the entire month, what you would find is that most of the boxes would be bigger in size. If the boxes were small, like this the first 2, but especially this first one, sort of skinny boxes, 1% change in the entire month from the beginning to the end. Oh, it's going up and down in between, but it's ending right there. Weirdly enough, that one, it went way up and then dropped way down because earnings happened on the last day of that month. So it ended very close to where it began, the month did. But I've done this many, many times, and it turns out that typically you will have 1 or 2 skinny boxes, and you'll have the other 10 in a given year, large boxes. And if we were to do that with Google, you could just see, just looking at the chart of Google, price goes up significantly in the month of April, significantly in the month of May, significantly in the month of June. Price goes down very significantly in the month of July. Not quite as significantly, but still a big box in August. September goes way down, comes way back up, and the change in between the two It's a little smaller, but still bigger than that first box. And then we had October here this year, which went flat right up until earnings, and then earnings shot way up, came down, and then now we have month of November, which we're in the middle of. But you can see just by looking at the chart, even with a stock like Google, which has not had a particularly incredible year, it's kind of a, back and forth typical year for Google. Within that, there are still really good moves, and they tend to trend away from where they started in larger increments than hold smaller increments throughout the month. And so this is a practical proof of the arcsign law. Now, what it says then is, hey, there are lots of times, even on a monthly basis, that you could use the arcsign law to capture a trend. If I come, so okay, that's the principle, right? That's what the arcsign law predicts, is that I should be able to find things like this. Small periods of time or long periods of time, I should be able to see trending behavior. Now what I need to do is find something that would give me an indication of how to anticipate those trends changing. And more importantly, what do I do if the trend starts? How do I know when to capture it, right? Mm-hmm. And so those are two different questions, and you got to answer both. The second one is you need to come up with a way where you say, I'm going to set a stop loss to a small amount if it doesn't trend, but I let it run if it does trend. A trailing stop is a really easy mechanical way to do that. Okay. It's also useful to have.
What do you mean? Let's break it down. Let's break it down. Let's break it down for a bit.
Go ahead.
No. So for me, I would like to clarify what do you actually mean here? Because speaking about how do you construct, all right, we have understood the arcsign law. Now we would like to implement it. So we saw the visuals. We pretty much understood how we can take advantage of. Now for me, the next move is to understand how would you consider your usage within that mechanical way. So you just insert the Donchian channels right here. So
on the screen, you're right. I added Donchian channels. This is the simplest visualization out there, I think, for a trailing stop.
What? All right. Please continue.
Okay, so a trailing stop is the easiest way to capture the value of trends when they come along. Okay? Mm-hmm. And usually when you go into a broker and you just say, hey, put a trailing stop, you specify an amount, 5%, 10%, whatever, right? Mm-hmm. And that's a simple mechanical way to create a trailing stop. I don't have a study that visualizes that on the screen, but I do have the Donchian channels, which are they simply work as saying lowest low in the last 20 days. That's the default setting. I mean, you can change the number of days you want. Lowest low in the last 20 days or highest high in the last 20 days, and it just tracks those. And so if you go 20 days and you don't make a lower low, but your price keeps going up, then eventually the Donchian channel starts going up underneath your price. As you can see here on this Google chart, the low point of the year was March, early in March, and from that point on, 20 days forward, the Donchian channel is just flat. But price, because it keeps going up from there, all of a sudden 20 days later, the Donchian channel turns up rather steeply, mirroring the price, right? And if you were to set the Donchian channel as your stop loss, it's a sort of manually implemented, or if you're algorithmic, then you're actually programming. It's a sort of stepwise trailing stop. I actually like it. I think it does even better than a mechanical trailing stop where you just move up based on a percentage, because it's basically hitting those low points. These are places where buyers jumped in, right? And saying, okay, We're going to track those low points and we're just going to move along there. If all of a sudden that gets violated, that's a great opportunity to just cut your losses and get right out of the trade, because it's likely it's going to keep going down lower. Not all the time, but often that turns out to be true. So notice this example right here. If I just use the Donchian channel as a trailing stop, see how it just stays out of the way of price for a long time, all the way up until July, right? And then all of a sudden it comes way back and you get this point on earnings where it drops down and goes below the lowest low. And so then, of course, that's where you would get out if you were, following this. So if you had something that put you in the trade somewhere in the middle of March after it, made this upward turn, maybe when it crossed the 20-period moving average, right there is what I'm marking on the screen, just where it opened above the moving average. And then if you go from there to the place where it first opens below the Donchian channel, this level right here, then you can see that's a 24.5% move from March 13th to July, middle of March to middle of July. And that is the bulk of what Google did all year long. It doesn't catch the bottom, it doesn't catch the top, but it catches a really easy move in between. Now compare that to, what if you had been wrong, right? What if you said, okay, I got in there at that day and then the price went down and went below the Donchian channel, okay? Well, the Donchian channel would have held, and it's 6% lower. See that? So in this particular case, I have a trade that I could say, set my stop loss 6% lower or 6.5% lower, whatever. If in fact the price comes down and takes me out, I'm out. How much did I lose? I lost 6.5% of the value of my shares. But if it goes good and it keeps trending, I have this opportunity, as you can see here, to make something like 4 times that, right?
Mhm.
It's not going to go that way every time. But if it's going to even go that way 1 out of 4 times, right? Then I'm in great shape. I'm in great shape. And here's the thing. My tests showed that trailing stops had the opportunity to capture big moves about 1 in 3, a little bit more than 1 in 3 times, 36 times out of 100. Now they won't all be, four times. Some will be 2 times, some will be 3, some will be 4, but some will be 5 or 6 or 8, So it's this variation. If I create a trading system that just has the ability to let those trends run, then I have something statistically valid that can give me the expectation that I can capture more of those kinds of trending moves. That is how you implement the principle behind the arcsign law into an algorithmic trading strategy. There are lots of ways to do this. There are hundreds of ways, maybe even
Let's do
millions.
another one. Let's do another way. Let's practice another way to implement the arcsign law within trading. Now,
Okay,
let's do it. Let's do it for intraday trading.
beautiful. Yes, I
Let's
love
go
that.
deeper in mathematics
Okay,
and
which
within that
stock would you
even
like to
deeper.
look at, or would you like to look at an index for your intraday trading?
Let's go for the futures.
Futures, ES. Okay.
Yeah. Nah, I don't know. You decide. But if we pick the ES, I'm
We'll
happy.
try it. We'll try the futures. 5-minute chart, 1-minute chart. What do you like?
Let's go for 15. Let's go for
15
30.
minute?
30 minute. 15. 15.
30
15
minute
seconds.
chart on the futures. Okay.
All right. Let's implement the RSLR right now.
Now, do you want to use something other than the Donchian channels?
I'm following after you, Master. I'm following after you.
All right. All right. Let's see if I can. Let's stick with the Donchian channel example. As I
You
say,
know what?
there.
For the matter of the practice and for the matter of the podcast, let's go for a different visualization. All right.
Okay.
I can completely rely to what you're saying that this is a slightly better way to to do it, but we'll just try something
Here's the
else.
Keltner channels. Okay, what the Keltner channels are is something slightly different from the Donchian channel. Donchian channel has a hard and fast. Hey, whatever the lowest low was, I'm going to stay there until a new, new lowest price of the last 20 days or 10 or 5 or whatever comes along. Keltner channel is gives me a moving average. By default, I think it's a 20 period moving average. And then it gives, it measures what the average true range is and says 2 average true ranges up and 2 average true ranges down. And it counts these bands. So if I were to say, I want to algorithmically trail a stop loss by having it 2 ATR, which is actually a very good number, 2 ATR below the moving average. And I'm going to get in when I cross the moving average, or I cross, it's actually even better if I get in when I cross the top of the top Keltner band, which is a little counterintuitive. People think, oh, well, that's too high. I need to not take that trade. But it turns out that trade actually has some edge to it. And that's a much longer explanation of why, but it is also related to the arc-sine law. Again, something that is going to trend, does it have more chance to trend or does it have less chance to trend? The arc-sine law would say more, but not necessarily the same direction. It could turn around and go the other direction and trend, right? So the arc-sine law isn't giving us an edge all by itself. It's just saying, look for edges in the trends. If you could somehow predict that there's even a slight amount of chance that you're going to trend up as opposed to down, then trade this way and plan on the trends. Use rules that will allow you to capture trends, and you should do well, okay? So let's say we're going to try and do that with the arc-sine law. And what we're going to do, or with the Keltner channels, what we're going to do is I'm just going to try to visually draw in this data set that's up on the screen, which is going from late October up until now on the futures. Now, I haven't looked at this chart. I had you just select it, and I just threw this on. So I have no idea what we're going to see. I hope that it demonstrates my point, and I think it will, because usually this kind of thing does work out.
Important disclaimer.
And so I'm going to draw a price range box. Yeah. Every time it opens, every time it closes above the upper Keltner channel band, I'm going to draw a box that will allow me to trail the stop using the lower Keltner channel band at the time. And if it hits the lower Keltner band before it goes double above, then it's a loss, okay? So here, as you can see, the first one in October, 25th of October, it crosses the top band, but then it comes back down before it goes twice as high. Oh, here, actually, let's use a different kind of box. We'll use this one, long position. All right, so I enter a long position here, and my stop is here, and I'm looking for a ratio of 2 to 1. So that's going to look like this right here, okay? That's the trade I'm looking to make. You can see this gets stopped out fairly quick. Got that? So that one's a loser. Now I'm going to do that again. Mark the next time we cross above the top. We're looking long only here, not looking for shorts. We'll go back and do the shorts a little later. Here's where it hits the top. I'm going to go down and hit the bottom. There's my stop loss. I'm looking for a ratio of 2 to 1. Okay, and as you can see, that's a loss too. All right. Now, this isn't any surprise to me because I expect that these kinds of trades should only win 36% of the time. 1 out of 3, a little bit more than 1 out of 3, right? First 2 are losers. Okay, no surprise. Here's the next time, right here on the 5th of November, right after the election, right? And there's the stop. We'll move that up a little bit. And the 2 to 1 ratio that I'm after is right here. Now, Instead of taking profits at 2-to-1, you can see this one's going to win 2-to-1. If I set up a hard, risk 1 to make 2, if I set up a profit-taking target, I would get it. I would get it here. And so out of these 3 trades, I would be at break even. The arcsign law says, though, that trends are more likely to occur, and I should let them run. So instead of just taking the profit, I've got to let this one run. As you can see here, if I use the Keltner channel, the lower band on the Keltner channel as my stop loss, I don't get stopped out. I don't get taken out of the trade until clear up here. And that ends up being a ratio of 5.64. So if I do the trade in this way, even in 3 trades, I lost the first 2, but the second one, I made more than double what the first 2 lost. So just in 3 trades, all of a sudden, I'm profitable. See that?
Mm-hmm. Sounds
And this is just with a random chart, just me just drawing it. Yeah. Did you follow that explanation?
100% sure. Yes, sir, as you say in America. That was incredible. I would have to say to you, Gordon, this one is highly incredible. By the way, when the 2025 curriculum of the CMT is being released?
I think it should be out in January.
January, this upcoming January.
Yes.
How can I access it?
Right on the cmtassociation.com, that website, there's a place where you can buy the books, buy the curriculum. I'm not sure. I think they might even be available on Amazon. My chapter, one of my chapters will appear in the level 1 curriculum, and the other one will appear in level 2. So the first one is all about the efficient markets hypothesis. The second one is a definition of what is alpha, what is beta, and some ideas for how do you capture alpha. I don't go back into the arcsign law, but I do look at other models such as the adaptive markets hypothesis and the fractal market hypothesis, which come up with ideas, and then I come up with a list of a dozen anomalies which are mentioned by those hypotheses and others. And these are all areas which in these dozen anomalies, in fact, though, let me do something for your podcasters. Let me share that list of anomalies, because each one of these anomalies, this is actually the manuscript for my second chapter in level 2. But down here at the bottom here, I have a list of anomalies, and each of these are areas that the arcsign law, using the principles of the arcsign law on these, there's one exception to that rule, but all the others, right? All the others, if you use the arcsign law on these anomalies, you have a good chance at finding edge in the markets, okay? Here, can you see these? I'm going to actually increase the size of the font. Can you see that list?
Mm-hmm.
So the first one, these are known market anomalies not explained by the efficient markets hypothesis. And it's acknowledged, right? It's not Eugene Fama himself in an interview with that the University of Chicago did. It's online. You can Google it and listen to it yourself. Very much worth a listen to. It's really great. Eugene Fama and Robert Thaler, the behavioral. It's a fantastic, fascinating conversation. Very worth listening to. But in there, he acknowledges, hey, sure, there are anomalies, but and we can't always explain how they happen, but there's few enough and far enough between that it's not worth paying attention to. Okay, I guess if you're an index investor, you can take that point of view and you just throw your money in SPY or Vanguard's VOO fund or something like that, right? And then you got to keep your fingers crossed that somebody out there, the guys at Apple or Google or Warren Buffett at Berkshire Hathaway, actually ends up beating the market and pushes the market average higher so that you can just coast along on the index, right? Fine. If that's the way you want to play the game, It's been proven valid for many years. But if you're interested in trying to beat the markets, then you need to know a few things, and you need to trade with much greater frequency and a whole lot of risk control. And the way you do that is you look for these kinds of anomalies that appear to be exploitable throughout intraday timeframes or swing trading timeframes or so forth. And because, even Eugene Fama would say, yeah, they happen. And I don't have time to, look into them. And the finance community isn't interested in that. Okay, he just admitted they're there, right? So here's the list. And there are others besides these, but these ones are, I went through literature and found, studies that supported each one of these ideas. The first is correlation in security returns. So when you have two securities moving along in a similar fashion, just as a simple example, you can think of Home Depot and Lowe's. Those are two different home improvement stores that are very similar in terms of the products they sell and the clientele they serve. There are small differences, but those small differences are enough to account. Oh, and of course, there are differences in the way they manage their business and their stores across the United States and so forth. But if you look at those two, their stocks are highly correlated. The stocks are also highly correlated to the market itself. They're so much correlated that if one day Home Depot comes out on earnings and says, we did so much better than we expected, if that's not the same day that Lowe's has its earnings, then Home Depot will jump up and Lowe's will jump up about the same, or somewhere close to that same amount. Why should that happen? We don't know anything about Lowe's. Maybe Lowe's has totally fumbled the ball. Maybe they've totally mismanaged their books. And when their earnings are going to come out, they're going to say the opposite. Oh, we lost so much money this quarter, right? It's not rational to assume that just because Home Depot did well, that Lowe's will do well. And yet that is precisely what professional institutional investors do. They make that assumption. They say Lowe's had a good year, not because some specialness in Lowe's management or practices, but because the whole industry, everybody out there just wanted to spend more, and and Home Depot was in a place to capture that. So if it worked for Home Depot, it's going to work for Lowe's as well. Now, admittedly, that's not a totally irrational decision. I mean, it's the kind of thing that you might feel comfortable trying to roll the dice on, but you have to comprehend it is a roll of the dice. There's nothing that requires Lowe's prices or profitability to go up just because Home Depot did. And so that weird anomaly, that's not market efficient. That's the market responding efficiently in terms of time, but not in terms of rationale. And so it's an anomaly that the efficient markets hypothesis cannot account for. And it's an anomaly that somebody could take advantage of, right? You could say, hey, one similar stock jumped up. Now on the next stock, I'm going to trade the possibility that we're going to get a huge divergence. It's because if all of a sudden Lowe's came out and said, yeah, Home Depot did well, but we did poorly. Well, you can bet their stock would tank rapidly because it already had good news priced in. But if bad news shows up, all the people have to redo their algorithms and rethink their valuation models and change everything, and price drops like a stone. So you go in there and you make a trade that says, all right, if it goes up, I'm going to lose. I'm going to cut my losses right here. But it's not going to go up that high because good news is already priced in. But if it goes down, I'm going to let that trend run. See, so now all of a sudden I've got a situation where I've got more profitability potential on the downside than on the upside. Great. That's an anomaly I can take advantage of. See how that works? Now, I don't want to take that much time to go through each one of these anomalies. I'm just going to read them through really quick. Mean reversion, that's the exception to the rules I've been talking about, so we'll skip over it. Underreaction to the news. Prices predictably continuing trends following both good or bad news. Hey, once you hear the news, that's it. It's all priced in. Why should the price keep going, right? Why should you get this one day where it jumps, but it tends to keep going for weeks, maybe a month after that news? Why should it do that? You could say, well, it just takes that time for all investors to hear about the news. Okay, but that would mean the markets are not efficient if that were true. So in other words, the mere fact that, hey, it doesn't move as far or as fast as it does, as it could all at once, that is an underreaction to the news, and that's not explained by the EMH. The size effect. Investors may correctly predict that small stocks outperform large stocks, even accounting for higher volatility. This is an anomaly that Eugene Fama himself has done studies on and come up with his own three-factor model for how to outperform the markets, and this is one of his first factors. The PE ratio, value investing. In other words, hey, look, if efficient markets hypothesis is true, then why does Warren Buffett make all the money he does? That shouldn't happen because he's
That's an
value
important
investing.
hypothesis.
Yeah, right. And
Mhm.
the next one is the January effect, where small cap stocks outperform early in the year. And why should that happen? That's not market efficiency. And then various patterns in volatility. Volatility markets will go up slower and down faster. So why is that? If you're more volatile, you're almost always a bear market. If you're less volatile, you're almost always a bull market. Why is that? That's not market efficiency. And yet it persists. So those are some anomalies that I wrote about in chapter 2. I shared them for your audience before they went to press. You're welcome.
Thank you. Thank you, Gordon. So, after a great discussion, every time that we speak, I learn a lot, and that time obviously was, I think, the greatest time that we spoke, and I really absorbed an incredible amount of knowledge, an incredible amount of new ideas that we can implement onto our day-to-day trading. And I would love to thank you for your participation within our show, the Trade Pod. I really appreciate it, and thank you for all the information that you have just shared. Thank you.
You're welcome.
Thank you. Thank you, Gordon. All right, guys. See you next time. Till then, bye bye.